LiteFinance, the world of financial freedom.
Hello, let's begin with the market forecast. On such a day, one would like to say from Russia with love. We have Valentine's Day, and the scenes we witness could be used in a film about Agent 007. But let's go back to reality. I will not speculate whether the Russians will launch an attack on Ukraine or not, although it seems unlikely. Putin in talks with the heads of Germany and France on the one hand ensures that he has no intentions of attacking, while in a conversation with President Biden he replies that NATO is expanding his influence in the East and that he would defend his borders. In the end, this conversation did not bring anything new, so as there was an uncertain situation about Putin's intention, it remained so. So maybe the Russians are waiting for the situation to develop and a decent excuse. Or is it a smokescreen and in fact something is happening that matters, but it is elsewhere in the world? But of course we will find out about that after some time. So on the other hand, the costs of the conflict would be considerable for the Russians, even unprofitable, despite the withdrawal of the SWIFT blockade from potential sanctions by Western countries. Since it is common knowledge that the Russian oligarchs have many businesses in Western countries like the US or the UK, so the blockade of their funds would most likely be a more severe consequence. When it comes to translating the whole situation into the markets, be it shares or currencies, well, it must be said that it was rather a little or no. Referring to the past, if we compare the period of the annexation of Crimea which happened in February and March 2014, the S&P 500 has grown in this period. Euro to dollar the same. Then the US index grew at its best, and only a few months later the dollar appreciated significantly in comparison to euro. So for a one-off event, it is difficult to talk about any strong impact on valuations. Even those nervous Friday movements after the US released of the information about the potential attack, the fact is that it caused some stir. We can check it on the volume indicator, which shows the number of ticks, but I would not call it a terrible panic. The S&P 500 fell by 2%, and I would be more inclined to the fact that investors were spooked by another news, namely how the Fed unexpectedly announced that there would be an unscheduled FOMC meeting on Monday, because the last time such an unexpected meeting took place, a series of interest rate hikes began. However, a few hours later, sentiment cooled down as the final QE program end schedule was released, which showed that the last 4 billion tranche is to be distributed on March 9th, a week before the FOMC meeting, where they will most likely announce a 50 basis point rate hike, which would exclude the option of a hike on Monday and abrupt to the QE. After last week's inflation reading in the US, which again exceeded the forecast, we can already read in various articles that the Fed has to start acting, that limiting QE is not enough. And here again, I have to emphasize not to listen to such a thesis. What can the Fed have to inflation? How does QE affect it? If this money doesn't even go to the market. So let's look at the CPI and interest rate charts again and compare them. The year is 2005, a series of increases has started and inflation has continued to rise. Years 2010 to 2016, we have record low interest rates and inflation is falling. I encourage you to check and compare for yourself on tradingeconomics.com. You will find everything for free. So returning to the information about the record CPI, the report shows that the prices of energy carriers such as gas, petrol and diesel oil, as well as cars, contributed mainly to this. A simple rule of supply and demand. There is a lesser amount of cars due to problems with supply chains. A week ago I talked about how Ford, like Skoda did last year, suspended 8 factories due to permanent problems with the supply of electronic chips. When it comes to raw materials, you remember the situation with the tankers in front of the ports. Back then there was too much of this oil, the price was falling and extraction drills were shutting down. And when it is easy to tell people, okay, from tomorrow we go back to work and open the economy, resuming work with extraction is not so simple and it takes time. So until production starts meeting demand, prices will go up. And as we well know, the reason for this state of affairs are lockdowns, which may be not to such extent but still occur in certain places around the world. Let's move on to the calendar. And well, when it comes to more important events, We start on the night on Monday to Tuesday with the first GDP reading from Japan for the last quarter of 2021. A little later, the minutes of the Australian Monetary Policy meeting. During the day, UK labour market data, the EW data on the German economic sentiment, flash GDP data from the Eurozone, and inflation from US producers. On Wednesday, inflation data from the UK and Canada, retail sales from the US, and minutes from the last Fed meeting. On Thursday, again in the middle of the night, employment data from Australia, and during the day, initial jobless claims and Philadelphia Fed Industrial Index. On Friday, only retail sales data from the UK and Canada. So now let's check some charts. On EURUSD, we have a price fighting with the current strong support. If we look a bit closer, we will see a false breakout of this ascending triangle marked with the orange lines and inverted head and shoulders pattern created, which is signaling continuation to the upside. On gold, we already broke through this triangle formation pattern. To see further increase, it would be best for us when the price would retest this upper boundary for this triangle and then continue the rally. In order to increase even stronger, the 50 Fibo level should be broken as well. If the price got back to the formation with as strong move as it did went outside, I mean long candles, then we should assess the chart again and think of something else. As for oil, on WTI we are in a range between $90 and $100 psychological levels. I would trade long any pullbacks to 90 level and look for shorts on $100 level. You can see on the left side that this consolidation was quite broad, and we can expect the same right now, since the price levels are more and more attractive to other varieties of oil extraction methods, and so more oil will be flooding into the market, therefore the price from those levels will start to move sideways more often. And okay, that's it all for today. Thank you for watching, and till next time.